Pause whatever you're doing right now. If you get Social Security, or if you're planning to, what I'm about to tell you could cost you thousands of dollars every single year. Also, many retirees have truly no clue this is happening to them. We're talking over $3,200 gone silently, legally, each year. This is not a glitch. This is not an error. This is the tax system. Plus, 7 states are still doing it in 2026. Stick with me, because by the end of this video, you'll know precisely which states are taking your money, just how much they're taking, and most crucially, what you can practically do about it. Alright, dive into it. Here is what occurred. For decades, retirees throughout America believed that when they reached retirement age, their Social Security benefits were theirs, completely and unencumbered. After all, you contributed into the system your whole working life. 30, 40, sometimes 50 years of payroll taxes.
Frustrated that money was expected to return back to you. Additionally, at the federal level, indeed, some of it may be taxed depending on your income. That's a separate topic, but here's where it gets worse. On top of federal taxes, 7 states in 2026 are still levying their own state-level income tax to your Social Security benefits. That's right. While dozens of states have already eliminated this tax or never had it in the first place, 7 states are still reaching into your retirement check and taking a cut. And the numbers are not small. We're talking hundreds, even thousands of dollars per year, depending on where you live and how much you receive. Now, some states have recently made changes. A few are phasing this tax out, but the phase-outs are slow. The exemptions have strict income limits and millions of retirees are still getting hit hard in 2026. This is huge, and it directly affects your financial security. So let's break it down state by state so you know precisely where you stand. These are the 7 states still taxing Social Security benefits in 2026. Take notes. Share this with your family because this information is critical. Number 1. Colorado taxes Social Security benefits. But here's the nuance. If you are under 65, there is a limited deduction available. Once you reach 65, the deduction becomes more generous. But if your income exceeds certain thresholds, you are still paying state tax on a portion of your benefits. Colorado's state income tax rate is a flat 4.4%. That doesn't sound huge until you do the math. If $15,000 of your Social Security benefit is taxable at the state level, you're looking at $660 gone just like that. Number 2, Connecticut. Connecticut is one of the more stringent states on this list. If your adjusted gross income exceeds $75,000 as a single filer, or $100,000 for married couples filing jointly, your Social Security benefits are taxed at the full state income tax rate. Connecticut's top rate reaches 6.99%. For a retiree receiving average benefits and sitting just above that income threshold, the hit can easily reach $1,000 to $1,500 per year. Connecticut has been considering expanding exemptions, but as of 2026, those income caps remain in place. If you're above them, you're paying. Number 3, Minnesota. Minnesota is one of the hardest states for retirees on this list. The state taxes Social Security benefits as regular income, with rates ranging from 5.35% all the way up to 9.85% for higher earners. Additionally, Minnesota does offer a special Social Security income subtraction, but the exemption phases out at relatively modest income levels. Single filers with income above roughly $62,000 and married couples above $79,000 start losing that exemption fast. For middle-income retirees in Minnesota who don't qualify for the full subtraction, we're talking potential state-level tax bills of $1,500 to $2,500 per year on their benefits alone. This is one of the main reasons Minnesota frequently tops list of the least tax-friendly states for retirees. Number 4, Montana taxes Social Security benefits, and the exemptions here are notably low. Single filers with income above just $25,000 and married couples above $32,000 can end up with their benefits taxed. Montana's income tax rate tops out at 6.75%. What makes Montana particularly painful is those low income thresholds. You don't have to be wealthy to get hit here. A modest fixed income can push you right into taxable territory. Number 5, New Mexico. New Mexico has been making moves. The state has expanded exemptions in recent years. As of 2026, single filers with income under $100,000 and married couples under $150,000 are exempt from state Social Security taxes. But here's the catch. If you exceed those limits, New Mexico taxes your benefits at rates up to 5.9%. And for retirees with pension income, investment income, or part-time work stacked on top of Social Security, hitting that $100,000 single filer threshold is more common than you'd think. Number 6, Rhode Island. Rhode Island taxes Social Security, but offers an exemption that phases out at higher incomes. If you're below full retirement age, or if your income exceeds the state's threshold, roughly $88,950 for single filers in recent years, you're in taxable territory. Rhode Island's income tax rate ranges from 3.75% to 5.99%. For retirees just above the exemption cutoff, this often translates to $400 to $900 per year in added state tax burden. Number 7, Vermont. Vermont rounds out our list, and it's another high-tax state retirees need to watch carefully. Vermont taxes Social Security benefits with exemptions available only for lower-income filers. Single filers with income below $45,000 and married couples below $60,000 qualify for full exemption. Above those thresholds, your benefits are taxed at Vermont's income tax rates, which reach as high as 8.75%. For a Vermont retiree receiving $20,000 in Social Security annually with income above the exemption limit, a state tax liability of over $500 just on those benefits is entirely realistic. Pause. Let it land. 7 states, real money, real impact, and if you're finding this helpful right now, do me a quick favor. Hit that like button. It helps more retirees find this information when they need it most. Let's talk about what this really means for real people. The average Social Security benefit in 2026 is approximately $1.87 per month, or about $22,884 per year. Now, not every dollar of that is necessarily subject to state tax. It depends on your total income, your filing status, and the specific rules of your state. But let's run a realistic scenario. Say you're a married couple in Minnesota. Combined Social Security income of $38,000 per year. You also have a modest pension, maybe $25,000 annually. Your total income, $63,000. You're above Minnesota's phase-out threshold. A significant portion of your Social Security is now taxable at the state level. After applying their top applicable rate, you could be looking at $2,000 to $2,800 in state tax just on your Social Security benefits. Add to that the federal tax bite because yes, up to 85% of your benefits can be federally taxed depending on income, and suddenly your retirement income is taking hits from 2 directions simultaneously. Now consider a single retiree in Vermont, Social Security of $20,000, a small IRA withdrawal of $15,000. Total income $35,000. They're below Vermont's full exemption threshold, but just barely. Any additional income, a part-time job, selling stock could push them over. This is a trap, a financial trap built into the tax code, and most retirees don't see it coming until it's already hit them. Some retirees are losing over $3,200 per year when you factor in both the state and federal tax layers on their benefits. That's $260 every single month. Gone. For someone on a fixed income, that is not a rounding error. That is groceries. That is medication. That is the difference between financial stability and financial stress. And here's what really matters. And this is entirely legal. States have the right to do this, but that doesn't mean you have to sit back and accept the hit without a plan. Stay right there because next I'm going to tell you exactly what you can do about this. Knowledge without action is just frustration. So let's talk strategy. Here's what you can actually do if you live in one of these 7 states, or if you're planning your retirement and want to avoid this hit entirely. Strategy number 1, consider a relocation review. This is the big one, and I know it sounds drastic, but hear me out. 41 states plus Washington, D.C. do not tax Social Security benefits at the state level. None. Zero. States like Florida, Texas, Nevada, Tennessee, and Wyoming have no state income tax at all. Others like Illinois, Pennsylvania, and Mississippi specifically exempt Social Security from state taxes. If you are paying $2,000 or $3,000 per year in state taxes on your benefits, and you're going to be retired for 20 or 25 years, that's $40,000 to $75,000 over your retirement timeline. The math on relocation, especially to a lower cost of living state that also doesn't tax Social Security, can be genuinely transformative. This is a conversation worth having with your financial advisor. Strategy number 2, income management. Many of these state tax exemptions have income thresholds. That means the amount of taxable income you have in a given year determines whether your Social Security gets taxed. Work with a tax professional to manage what's called your provisional income, the total income figure used to calculate how much of your Social Security is taxable. Strategies like Roth conversions and pre-retirement years, timing of IRA withdrawals, or managing capital gains can all help keep your income below critical thresholds. Strategy number 3, know the exemptions cold. Every state on this list has specific exemptions based on age, income, or filing status. Know them, read them, apply for them. Some retirees are paying taxes they don't legally owe simply because they didn't know about the exemption or didn't apply it correctly on their return. A qualified CPA who specializes in retirement tax planning is worth their weight in gold here. Strategy number 4, stay informed on legislative changes. Several states on this list, including Connecticut and New Mexico, have been expanding exemptions in recent years due to political pressure and demographic shifts. Colorado and Connecticut in particular have had ongoing legislative debates about eliminating this tax entirely. Changes can happen, and if your state does eliminate the tax, you need to know about it immediately so you can adjust your withholding, your estimated payments, and your planning. Subscribe to State Tax Authority updates, follow Retirement Financial News, and of course, subscribe to this channel because we cover these changes as they happen. Here's what I'm watching going forward, and this changes everything for retirement planning in the years ahead. The political pressure to eliminate Social Security taxation at both the state and federal level is growing rapidly. At the federal level, there have been renewed discussions in Congress about raising the income thresholds at which Social Security becomes taxable. Thresholds that shockingly have not been meaningfully updated since 1984. In 1984, very few retirees hit those thresholds. Today, because of inflation and rising benefit amounts, the majority of Social Security recipients pay some federal tax on their benefits. That is a political pressure cooker. At the state level, the trend is clear. States are moving away from taxing Social Security. We've seen multiple states eliminate or dramatically reduce this tax over the past decade. The question is not if the remaining 7 states will follow. The question is when. But here's the hard truth. When changes happen, they rarely happen automatically for you. You have to know they happened. You have to act on them. That's exactly why staying informed is not optional in retirement. It is a financial survival skill. This is why I make these videos, and this is why you need to be subscribed. Let's bring this home. 7 states are still taxing Social Security benefits in 2026. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Vermont. Depending on where you live, your income level, your filing status, and your total retirement picture, you could be losing anywhere from several hundred to over $3,200 per year. That is real money. Your money, money you earned over a lifetime of work. The system is not going to warn you. Your state is not going to send you a letter saying, hey, here's how to reduce your tax bill. That's not how this works. You have to know the rules, you have to plan around them, and you have to stay ahead of the changes. Here's your action plan starting today. 1. Find out if your state is on this list. If it is, get your last 2 years of state tax returns and look at exactly how much you paid in Social Security taxes. 2. Book a consultation with a retirement-focused CPA or financial advisor. Ask specifically about your provisional income and your state's Social Security tax exemption rules. 3, if you're in the pre-retirement planning phase and have flexibility on where you retire, run the numbers on relocation. The tax savings over a 20-year retirement can be genuinely life-changing. 4, stay informed. Tax laws change, exemptions expand, new legislation passes. The retirees who win are the ones who pay attention. And if this video gave you clarity, if it opened your eyes to something you didn't fully understand before, then do 3 things right now. Hit that like button. It takes 1 second, and it helps thousands of other retirees find this information. Leave a comment below. Tell me, are you in one of these 7 states? Are you being hit by this tax? I read every comment and I want to hear from you. And subscribe because this channel exists for one reason: to give you the financial knowledge you need to protect your retirement, your income, and your future. The information is out there, but most people don't have it. Now you do. Disclaimer: this video is for educational, informational purposes only. It does not constitute legal, tax, or financial advice. Tax laws vary by individual circumstance and change frequently. Please consult a qualified tax professional or financial advisor before making any decisions based on this content.